Welcome everyone to part 10, Trade Management Techniques of the 10-part Executive Training Series. I am Frank Ochoa, aka Pivot Boss, and in this lesson we're going to be discussing trade management techniques. These techniques are designed to help you basically mitigate your risk, help you scale out of opportunities so that you can limit your risk, and from there learn how to book consistent profits and offer flexibility while you're in any type of trading scenario. So these are fantastic techniques that you can use in any time frame, in any instrument, and you can use them in any way you like, basically interchangeably. You can add portions to these scales, and I'm going to give you four solid trade management techniques. And again, they offer high flexibility so that you can use them, interchange them, however you see fit for the given opportunities that you're trading. So let's go ahead and get started with part 10, Trade Management Techniques. So first off, the PivotBoss method relies on a variety of scaling techniques that are designed to mitigate risk, book consistent profits, and offer flexibility while managing a position. And that's really the goal of trade management as I see it. I mean, if you look at the bottom of the screen here, there's a quote from Paul Tudor Jones, perhaps one of the best traders of all time here. And he says, "Don't focus on making money. Focus on protecting what you have. The most important rule of trading is to play great defense, not great offense." And that's important right there. And that's all about trade management. That tells you it's about mitigating your risk. It's about eliminating or reducing risk at all costs. And from there, learning how to navigate your way through a position so that you can manage it in the most responsible way that gives a better odds for success. It's often said that, back in the day or even more recently, that floor traders only made money on 40% of their trades. So it was assumed by most novice traders that on the other 60%, they're losing money. And that's a wrong assumption. They may make money on 40% of their trades only, but the other 60% are not losing trades. They're break-evens. And break-evens in my book are not losing trades. They're a winning trade because you're executing your techniques as you're supposed to and you're protecting your capital as you're supposed to. Remember, if we don't have capital, we can't play the game. So you got to keep the capital so that you can continue to be alive in the game. And that's the basic thing of this whole portion of training is protecting what you have from not only a monetary capital perspective, but also from a mental capital perspective. Because if you are not employing the right trade management techniques and you're allowing yourself to get stopped out time and time again because you're not scaling appropriately and you're just losing money consistently, that really wanes on you. I mean, it really affects you heavily, especially mentally, and that can really lead to additional poor trading. So it's really important that when you are using trade management techniques, whether you're using these specifically or variations of these in addition to what you already do well, it's very important to know that these are designed to help you create great habits. You don't have to use these as gospel. You don't have to say, this is the 11 scaling technique, this is how you use it. This is the 21, this is how you use it. These aren't set in stone. Instead, these are ways. These are ways for you to reduce your risk and navigate through a trade so that you are creating the habits of booking consistent profits. You're creating the habit of making money instead of creating the habit of hitting stop losses. Instead, you're playing to quicker profit targets and you're scaling out of your trades early so that you're offsetting that risk, even should price come back against you and take out your stops. So that's what this is going to be about here as we move forward. I wanted to talk about a few of the advantages here of the trade management approaches that we use. That's these 7 advantages here. Number 1, real quickly, these are great all-purpose trade management strategies. So you can use them in any trading scenario you want, with any instrument, in any time frame. For the longest time, I used the 11 scaling technique. And that's the one I developed a long, long time ago when I was first trying to really establish that great consistency. And it's merely scaling out of half and half, and then from there it was kind of like my just my go-to trade management approach when I needed to make that trade or I needed to be risk averse because we were at a significant key level. This is the one I went to. And then from there, I adopted it to this one because this is the same thing. You're scaling half first, and then from there, you're scaling the last portions quarter. So this is very quick to adapt to a different portion. This one offers more flexibility because it's a 3-part. You have more parts to work with. And from there, obviously, a lot of pro traders that I've come in contact to really prefer an 11 scaling technique where you're going a third, a third, a third. And there's different ways to structure those exits so that you get to 0, break even faster, or you can, allow it to be a little more lax. There's different ways to scale those thirds. And then from there also, if you have a slump, a poor trading slump, a 21 scaling technique is usually the one to go to. Because in this case, you're still using 3 units, but you're scaling out of 2/3 of the trade on the first scale. So you're guaranteeing a profit if you can just get to the first scale. You're guaranteeing a profit, and then you just have a third trailing just in case. So these are various ones that you can use depending upon the trading scenarios that you're going to encounter. Next this is perfect for traders of all account sizes. Well, what I love about this approach is that it doesn't matter what size your account is. It doesn't matter if you're trading 100 contracts of crude oil or 2 contracts of crude oil. It doesn't matter if you're trading ETFs and trading just 100 shares of USO or trading 1,000 shares of USO. Maybe you're trading Apple. It doesn't matter what you're trading because these units right here, each unit can have however many number of shares or contracts you want per unit. So if I'm using the 11 scaling technique and the ES, that's the ES, so it's a futures contract. You have to trade 1 unit at least on the first, or 1 contract on the first unit at least, and 1 unit on the second. So you need at least 2 units to trade the 11 scaling technique here. So 2 contracts, right? But if you're trading something like the SPY, which is an ETF, then you can trade 100 contracts, right? And then each scale would then be 50 contracts per unit. Or you can trade 50 shares, and each scale would be 25 shares per unit. Or you can trade 1,000 shares of SPY, and each contract or each scale, each unit will be 500. So you can see how you can use this. It doesn't matter which account size you have, you can use this approach. And this is what's fantastic. And this is where I say that this is the secret to making more money without having to make or force price to go farther in your direction. If you get good at making a 3-point trade in the ES, like I said before, just 3 points. If when you pull the trigger, you have a high tendency to see the ES move at least 3 points in your favor. Well, say you traded that with just 1 contract, right? It's $50 a point. That's going to be $150, right? That same 3-point ES trade can be traded with 10 contracts. And now you've done nothing different in terms of identifying a 3-point move. You've pushed the same buy button, and now instead of making $150, you just made $1,500, right? Well, what if you do 20 contracts? It's just the art of making the 3-point move without adverse excursion. You have to be able to enter these trades without too much adverse excursion. And that's why when we're looking at our trades, we're not seeing a whole lot of movement against us. If I say this is the level right here, or this is the level we're looking at, or here's where I would buy, or this is the go zone because of the footprint, all those things, we never really saw price come back against us too much, if at all, during that entry phase. And then price went enough in our favor to scale out. That's what you want to do once you start trading larger size. You can't if you're trading 10 contracts, or say you're trading 100 contracts of the ES, you cannot afford to hold a 3-point loss. This is not fun. It's not fun holding a 3-point loss, holding us on size, right? So you have to be more nimble. You have to be more accurate when you're doing that. But again, if you're trading like an investor and you're trading higher time frames, say you're trading a swing chart, say you're trading the S&P 500 ETF, so you're trading the SPY, or say you're trading Yahoo or whatever the case is. Then from a higher time frame perspective, you don't have to be so razor sharp on your entries and exits. We have ways and rules that we use, like the midpoint. But for example, if you have a big, you know, candlestick that looks like this and there's a rejection tail here, it looks like this thing might be headed higher. Here's a midpoint retest. So price comes down in the midpoint and hits that price and then bounces, okay? Well, whenever we establish that trade management, it can be in or around this zone. It doesn't have to be perfectly the midpoint. It can come down. Sometimes it's just perfect. It just looks that way because it is that way. Sometimes it front runs it a little bit. But the goal is you're likely going to have your stop way down here, right? So there's some wiggle room there. You don't have to be perfect. And in this case, you can still say if I have this stop right here in whatever stock, say that's a 1 point stop, then whenever price bounces 1 point in my favor, I'm exiting half that trade. And now here we are on an 11 technique, and now we're break even. If I can just reach this target and scale out a half, I'm break even if price comes all the way to my loss. So this is where you can use these techniques if you want to be a super aggressive scalper down in the lowest time frames, or if you want to be on the highest time frames using a weekly chart as an investor, you can do this as well. Because these are techniques, again, that I've developed so that I can use them in any time frame. Because I manage and trade higher time frames all the way up. If my family says, hey, what about these mutual funds in my 401k or in my IRA or whatever the case is, I look at it, I follow these approaches. Everything I teach you here, I follow these approaches. I use the same things for the higher time frame accounts as I would in a lower time frame when we're looking at the footprint right here. And that was important to me. Being able to create universal techniques and tools so that we can use them in any time frame in any instrument is very, very important to me. And that's what we've done here. So the first thing is, as soon as you get into the trade, the idea here is to scale out immediately. Scale out of some portion of your trade so that you reduce your risk as price moves in your favor. Okay? That's the number one thing. You have to reduce your risk, because as soon as you get into a trade, that's the point at which your trade is at most at risk, because that's when it's closest to that exit. But if you can get a favorable move in your direction, that's enough to get you out of a portion of that trade so that you lessen the burden of risk there. You mitigate some of that or offset some of that risk. And that's what these are designed to do. Additionally, these are designed to remove emotion from trading. And that's important. The more you can remove yourself from what's happening in the charts and what's happening in your account, the better off you're going to be, because you start to condition yourself to be more mechanical, almost like a robot. So, you're just, when you see an opportunity, you read, react, and then you push the trigger button, and then you enter that trade, and now automatically you've already created one of these profiles that you trade. So say I say, enter the ES, boom, buy long. Now it says, okay, here's the entry. We're using 11 techniques, so I'm going to scale half here, and here's my first target, right? It automatically knows what you're doing. Ideally, that's what you're using. If not, just enter it automatically or manually yourself. But the idea is to just input it automatically, almost like a machine. You're just doing your job. If your stop is hit, it's hit. It's a losing trade, but that's okay. It's not a bad trade. It lost money, but it's not a bad trade. You did exactly as you were supposed to do. Your stop loss was hit is exactly what's supposed to happen. You're supposed to limit your risk, and hitting your final stop loss is part of that sometimes, and that's okay. Move on to the next one. Do not associate losing trades with bad trades. They're different. Losing trade just means it lost money. A bad trade is something different. Something bad happened, or maybe you didn't execute right, or you didn't follow your rules. Those are bad trades. When you don't follow your trading rules, you don't follow your stops, that's a bad trade. A trade that just goes against you after your entry and hits your stop, that's just a losing trade. You did what you're supposed to do, move on. Number 5, these are designed to book consistent profits. So, in terms of getting consistent, a lot of times you just have to eliminate those losing trades. That's all you have to do. Each of you make great winning trades. Every one of us will hit a home run. If you keep swinging, you're gonna hit some good trades, right? And you have some trades some go-to trades that you like. But now it's about eliminating the bad trades. And that's where booking consistent profits does that. Because as soon as you get into the trade, instead of waiting around and hoping it's going to go much, much higher, program yourself to book that first profit. As soon as price goes in your favor, it's conditioning you to take money. When the market gives it to you, take it. When the market gives it to you, take it. You're conditioning yourself to make money. So now all you know is book profits, book profits, book profits, instead of stop loss, stop loss, stop loss. We're not thinking about stop losses. We're thinking about profit targets. We're thinking about hitting our targets and making money. So if you have to, make your first profit target close. Whatever you have to do. If you need to make it 4 ticks away from your entry, make it 4 ticks. And you're going to see more often than not, you're going to get those 4 ticks, 4 ticks, 4 ticks consistently. And then you're like, you know what? I'm going to go for 8 ticks or 6 ticks. And you'll find that you have a sweet spot. When you enter a trade, you're going to get a certain amount of bounce in your direction because you're finding these so well. Or maybe you see a trap buyer or a seller and you see an initial movement. Now you know a retest on where that retest zone should or could be. And from there, pounce on it and book that first profit so you're not at risk. So it's all about consistently booking profits. These are also designed to inspire confidence. Because of the way they're used, you're booking profits quickly, and what that does is it makes you happy. You start booking consistent profits. This helps build your confidence. You see that your skill is growing because you're not losing so much, and instead you're booking these small profits that are adding up. Now your confidence starts to build, and then you start getting experience doing this over and over and over again. And that's really where this comes into effect, is becoming kind of like a machine where you're just using these techniques consistently. And of course, anytime you can build your confidence here with these, you're doing something right, especially when the results show themselves. And again, lastly here, perfect for traders struggling with consistency, or perfect for novice traders. So if you're novice or you're struggling with consistency, again, this technique right here, and especially this one, both of these would be the ones to really gravitate toward, because these help you begin to book small winners and stop losing money so much. You're going to end up with a lot of small winners with some of these, like this one, maybe small winners, and you're going to end up with lots of break-evens or pluses. That's it, break-evens or pluses. So these are all kind of inherently developed so that all of these great advantages are kind of built into them. And again, the whole goal is to trade from a position of strength. And that just means that you have the control while you're in the trade. You have the control and flexibility to do things. If you can scale at that first scale, that gives you a position of strength because you've already booked profits, you've already mitigated risk. Now you have some extra units on the sidelines that you can put back to play if price comes back and retest a key level that you like. Then you can put some to play. You can't do that if you're not managing your trades well and price is just going against you. You have to be able to trade from a position of strength. So let's just drop into the charts and look at some of these scenarios now. So let's look at a couple of things that happened today. Here's crude oil. Right now you can see the dance that's happening around 30.42 as bulls tried to defend that zone after the recent squeeze. I really like event-based trading where you see an event happen, okay? And this is an event right here. This was a small event, but it was also an event that really happened. It's a VPOC shift. And in this case, VPOC right here shifted up to here, okay? And then as soon as that shift occurs, you can see price came below and then rallied up. Then when it came back to it right here, it's bid. Look at that precision. It's bid, and then you see this impulse move up to here. That's the VPOC shift buy program that the algos employ. VPOC shift algo buy program. Boom, pow. Okay? So when that happens, price should drop back to VPOC, and from there, limit orders have already been put in here. After this bounce went bid, limit orders were simultaneously put right there to defend that zone. And then you see the aftermath right to the next key level. This is why I say I have some of the best key levels out there, because when we put a key level on the chart, it's going to react. I mean, these things are just, they react so well. We know what price responds to, right? So if we're going to use an entry approach, if price goes bid here and rallies, our idea is let's put a limit order back here. Generally speaking, that's generally the idea. When price does drop into there, your limit is filled, okay? Now, if we're looking at this and we're saying, okay, where's this price? And it's 30.08. In crude, you know, it depends on how big my exits can be. It depends on the volatility. You know, generally speaking, somewhere between 10 and 12 ticks is a good stop for me. 8 or 12 ticks can be a good stop. Just depends on the volatility. It depends on what things look like. But say you did 10, just around 10 ticks. Okay, 10 ticks. If 30.08 is your target entry and you get filled on that limit, then your stop becomes 29.98. Okay, so that's 10 ticks right here, 10 ticks. And this is your entry right on that level. Now, if we're using the 11 scaling technique, it's called 11 because you scale 1 unit at part 1, and then you scale 1 unit at part 2. So it's a half and half deal. It's 11. You scale 1 unit and 1 unit. It's 11. Just scale them halves. So say you have crude oil. Since this is a contract, you have to trade either 2 or multiples that can be divided by 2, right? So 2 or 4 or 6. I can trade 10 if I wanted to and go 5 in each one. Whatever you want to do, right? So let's just say it's 2 contracts, 1 and 1. So when price comes to this zone, you're filled at 2 contracts right there. And since you have a 10 tick stop loss right here, 10 ticks, you have 2 contracts on it right there. So as soon as you get in and you're filled 2 contracts right at the level. And then immediately you go 10 ticks up, and right here, this is T1. That's T1. You have one unit waiting there to be filled as a target. Okay? So when price rallies into that level, you've already exited 1 contract at plus 10. See, this was a minus 10 here on 2 contracts, so you're risking 20 ticks. Well, since I just made 10 ticks on the first half here, plus 10, right? I made plus 10 right there on that 1 contract. Now this goes down to 1 contract, and 1 contract on 10 ticks drops this to 10 ticks, minus 10 ticks. So now I have 1 contract left, and if I keep the same stop at 10 here, when price comes down and I lose 10 ticks, well, I made 10 ticks on the first one, and that equals 0 loss minus commission. That's the 11 scaling technique, and that's the math behind it. It can be 10 ticks as your stop loss. It can be 20 ticks as your stop loss. You can make it whatever you want. You can make this a $1 stop loss if you're using a daily time frame if you want to. You know, it's just whatever you want it to be, whatever you're comfortable with your risk profile. In this case, if you're trading 2 contracts and you're risking 10 ticks, then you're risking $200 on that trade. So if price tests right here and then immediately went against me and stopped me out, you'd lose $200 on that trade minus commission. So you have to be willing to accept a $200 loss if you're going to use this approach, right? That's where I go back to, if you're going to enter a trade, and this goes back to yesterday's entry techniques discussion in part 9, if you're going to enter a trade, then it needs to be, you need to know your risk ahead of time. You need to know when you're going to get out of the trade if you're wrong, how much that's going to cost you. You need to know when you're going to scale out of the trade if it goes in your favor. You need to know those things. So in this case, that's how you play it with a 1 and 1. So when price goes up 10 ticks right here, boom, let's get plus 10 because we had 10 ticks as our stop. And now when price continues higher, now you take that last one and you say, where do you want to take it to? Well, now you shoot for the next key level. You shoot for the next thing higher. You know, sometimes it's VWAP, sometimes it's the midpoint, sometimes it's a key level like this, sometimes it's VPOC. You know, whatever that case may be. Sometimes it's just, hey, what's this move right here from here to here? What is that? 98 to 20 to 28? That's a 30 tick rally, so it probably should go 30 ticks above. It can do that. Or 30 ticks from down here, rather. So that puts you at about 38 right here. So you can play to 38. So whatever you want to do, you can use an ADR target and use it that way. Now, if you're using something like a 21 scaling technique, this one is designed to book you a profit. So if price comes in and you get that limit right here, same case, just because we know the numbers. Say we're using 10 tick stop again. Here's our 10 tick target. But this time we're using a 21 contract scaling technique. Scaling technique. So that means you need at least 3 contracts. So this needs to be at least 3 right here. So let's make it 3 contracts. So now we're risking $300 on this trade because we're using 3 contracts. We have a 10 tick stop. If price comes back to our stop, we lose $300, okay? So we have our stop right here, and then we have 3 contracts on that stop. So in this case, 21 technique would be for someone who really wants to build consistency quickly, really wants to just start consistently booking smaller profits and stop losing. You want to stop the bleeding. This is one that you can use when you're in a slump. So when price goes, say, 10 ticks up, right? So here's your plus 10. You're scaling 2 units here. You're scaling 2 units. So you just made a plus 20 here on those 2 units. So you just booked $200. And after price hits and scales there, if it comes all the way against you, remember this drops from 2 to now 1, or from 3 to 1, so it dropped 2. And now your risk here is only $100 if it hits this stop. Well, after booking 200 on the first scale, if it comes all the way against you and stops you out, then you've still made a plus $100. You've still made $100 on that trade. But you can see on the same move, structuring the contracts differently, how this thing turns out in terms of money. So again, if price were to have held here, as it did, so here's 30.18, you scale plus 2 contracts here, you still have 1 here, that's at your stop loss, and you're still long from 1 at the entry. So now when price goes to wherever you want that target to be, you can take off that last contract for whatever target, for whatever amount that is. So if you can get your first target here, you're guaranteed profit with this approach, and whatever you get after that is all gravy. So that's the 11 technique, and that's the 21 technique. So we just finished both of those. The 21 was the recent one. Now with the 211 technique, that's another one that's my favorite. That's my go-to favorite technique most of the time. But this one, since it's 211, you're scaling 2 units first, then singles after. So this is, you need at least 4 contracts if you're going to trade it on futures, right? It needs to be divisible by 4, right? So I can trade 4 contracts, but I can't trade 10. So in this case, here's our entry again, 30.08. Here's our 10 tick stop. Here's our 10 tick entry. And then now we're entering 4 units. So again, if it's 4 units, this could be 400 shares if you're trading stocks. It could be 100 shares because at 100 shares, the first scale would be 50, and then the second scale would be 25, and the third scale would be 25. Right? So this is how you kind of go across contracts and to shares. Okay, so here's your pullback, and now because we have a 10 tick exit here, this is going to be a $400 risk factor on this one. So this doubles our risk because we have double the contracts. So we'd lose $400 if this thing came back and hit our stop loss here. If we hit our T1 target here, then we're going to make plus 10, right? So that's a plus 10, and that's going to be on 2 contracts because you're going to scale 2 first. Remember, we scale 2 first, and then you scale singles later. That's the 211. So if you make it to the first target and you've scaled plus 10, now you've made $200 on that deal. on that first half of that trade. Since you've scaled out of 2 contracts of your 4, this one was originally 4 contracts for a loss. Now you can update this to 2, and this now drops to a minus 200 because you have 2 contracts left on the trade, but you just made 200. So now if price drops all the way against you and hits that stop loss, you've got a break-even trade. You've lost no money. So it's the same thing. Basically, we've done the same thing as the 11. We've scaled half right now on the front end, and now we're break even. Well, now you have extra contracts to play with. Now you have extra flexibility because you've just scaled 1 here on 2. Well, now you have 2 singles ready to go. So now you can trade to T2 here, wherever you want. You can trade to T3 up here if you want to. And that's how you would complete the last ones. Let's write this over again. If this is 30.08, here's our exit here, and then this is the first scale. So say we got out of 2 contracts right here. We're still holding 2 right here, and we had 2 stops right here, right? Well, maybe you can leave 1 stop here, and that will give you a minus 100 on that contract. So you put the other one right here, say 30.06. And this one's only, a minus 20 on that extra 1 contract if it goes against you. So, by staggering here, maybe sometimes you might hit this one, but you keep into this one. So you'll keep one. But maybe sometimes when you hit this one and you hit the bottom one, at least you've saved 8 ticks, so $80 on that little bit if that other one hits both of them. So it's just little things you can do here. Say you're reading the order flow and it's not looking as good as it had been. Something changed drastically. Well, then you can move your stops up and take advantage of however situation you want. You just start to get a little bit more flexibility. Additionally, say this is 30.08, 29.98, 30.18. Say you got in 4 here, you scaled 2 here, okay? Then all of a sudden price, pops into this level, and you're like, oh, wow, okay? And then you scaled out of another one here and took that move. Well, when price comes back to here and you start to see defense and support, well, this is a zone right here where you can add 1 back. Because after you scale 2 here, and then you scale a 3rd here, you're only down to a 1/4 position left. That means you made money on 3/4 of your position. So if you add a unit back, you're putting a little more money at play, and you're playing with house money now. The important thing is you never want to add to a losing trade. You always want to add to a winning trade. There's many ways to do things. So I know some professionals that are very good at adding to a losing trade, but you have to be a pro. You really have to know what you're doing. That's not advisable unless you really know what you're doing. I teach a few ways where you can add to a trade that's going against you, but I'd rather teach you how to avoid that situation and instead only add to trades that are going in your favor. So if we're making money from this move up on 3/4 of the trade, why not pull some money back into the trade because it has proven itself to be a good moving trade in your direction. So when price comes back and tries to seal these recent highs and make them a floor, you could be part of those buyers that are trying to defend and put money back to work for a shot at new highs. And then that's how you get the next wave up. So number 1, if you're going to add back to a trade, only add back to winners. So as Paul Tudor Jones said, winners add to winners, losers add to losers. Just keep that in mind. Secondly, if you're going to add back, say you added back +1 somewhere in here, wherever it may be, as soon as that one goes in your favor, take it off. Take the add back off. Just consider that a little bonus. Whatever you make right there on that add back, take it off. Because you don't want this add back becoming something that, becomes a liability and now it's messing up your profit potential or turning a good trade into a bad trade. Take off the add back quickly and just consider it a quick add back scale, just the cherry on top of a good move. Now you can, if this thing is developing into something that could become a swing position, then I will add back and leave it. But if this is just a day trade, add back and get out, add back and get out. If it's a swing trade that you're trying to build a position for longer time frames, then yeah, it's good to add and hold. But you just have to know the scenario you're trading for. Now, last one here is the 111, and the 111 has a lot of little quirks to it because you can do so many things with it. Here's 3008, here's 3018, and here's 2998. So a 111 technique, 111, you're going to get in 3 units. So when price drops into your spot, you're getting in 3 units. Here's your negative 10 or minus 10 down to here, and that's 3 units. So right now you're risking $300. Okay, you're risking $300. Now say price rallies to the plus 10, you're going to scale out a 1. Okay, that gives you a plus 10. That equals $100. Okay, for this one. Once you get that first scale of plus 10, there's a couple of things you can do with your trade. Number one, you can play to a break-even result. Okay, so what that then happens is you would say you go from 3 here to 1. You go from 3 here to 1, and you take this 300, and that becomes 100. So now you're only risking 1 down to here. The other 1 was taken off here, so you have 1 left. That one you move to the entry here. So if it comes back to the entry, you've lost 0 ticks, which is $0. If it comes all the way down and hits this one, you've lost $100, which you just made over here. So that's a break-even trade. Hopefully you followed that. I'll do it again real quick. So here's your entry, here's your exit, here's your T1. If you're going to use a 111 technique here, and you enter on your entry here, that's 3 contracts. That means you have 3 at your loss, your stop. You'll take a plus 1 up here. You'll take 1 unit off after 10 contracts up here. So basically, after you get your first scale, you move 1 of your stop contracts up to your entry and you leave 1 there. So now you have 1 here and 1 here, and you're still long 2 from the entry. So now if price comes back to here, you lose nothing. If price comes back to here, you've lost $100, but you made it on the first one, which is a break-even trade. So that's one way to go, right? So then, let's advance this thing further. Okay, so if this thing goes higher here, wherever you want to get out, say you make another plus 10 or plus 20 or plus whatever you want to make, and you take another contract off and scale somewhere. Now this single way down here, you don't even have to have it down there anymore. You know, you're way off up in here. You can move this to the entry as well now. You can trail above a prior low if you want to. Or you can add up all the money you've made in that trade and add it against, subtract it against your entry for that one contract. So say you made, so if we're trading 111 here, and you made a plus 10 on the first one, plus 10, and then you go up here and say you made a plus 20 on the second one, that's now a plus 30 that you've made on 2/3 of that trade. So now you can say minus 30 from 3008, puts me way down here, 78. So yeah, basically now instead of saying this would be your entry, because you've made money on all of these, on those first 2 contracts, effectively you can say this is your theoretical average entry on that trade. So now price would have to come, so from after you scale up here, price would have to come all the way back to here to get you out at break even. And that's how you're able to build a position on a swing basis. Because when you get into the higher time frames, I know this has only been on an intraday chart just for illustrative purposes, but if you get into the higher time frames, so say you're in a higher time frame chart now, and you're in here and you see this thing, boom, stab down as we thought. And you see this big rejection tail. Maybe you saw it during the day and you were able to get in somewhere in here and scale out along the way. Maybe not. Maybe you just saw it right here and you said, I'm going to try for the retest the next morning. So boom, you get in a retest here, and when the price goes up during the day and even in the next day, you could scale and add, scale and add, scale and add, right? And you're scaling and adding at these little opportune times. That's adding to your theoretical average entry. So by making a little bit of money here on those first portions of your contracts, for whatever you have that's left standing, so you have 1 unit left, that you're advancing that base runner from first base, second base, third base. Now you're trying to bring them home. Maybe you're trying to bring them all the way back to 1981 half, and it all comes back to defending and adding some of these. So then you effectively create a theoretical average entry that's actually much lower than where you enter the chart. So if you entered somewhere right here the next day, if you've scaled out along the way, your average entry actually can get down a little lower. And now price would have to come way down here to stop you out just to break even. And we didn't even think it was going to break this low, much less coming back here. So now you're in a trade where you can kind of hold and give it a little bit more nurturing. Let it work its way out. So that's how you can build a swing position in these things, where you can build that theoretical average entry, get it way against your entry, and then all of a sudden you're working with house money. All right, that's pretty good there. I think each of those are pretty straightforward. I wanted to get them in the can there and just kind of show you exactly what, how each of them can perform based off of just a standard trade that we're going to take in this room. The VPOC shift is just a standard trade. When you see that thing shift and you see it go bid or offered, then it's likely the retest is going to also be favorable in that direction. So that's how you can position yourself with either one of those trade management techniques. So we covered the 11 scaling technique, the 21, the 111, the 211, and again, each of these can be used in a variety of ways. And you can even add back and scale out, and you can, create hybrids. You can do anything you want. You may not have to at all because they're fine the way they are. But at the same time, when you get into a trade with a 211, you got 4 units that you're working with, 4 units that you can play with, that you can create a lot of flexibility and trade from a position of strength. When you're using the 11 scaling technique or the 21, you're going for consistency. You're going to book that profit. You're tired of that slump you're in. You're tired of your account maybe going down a little bit. You want to create some confidence. You want to create a little bit of positive profit potential. Start using these 2 right here. If you think you're pretty much well along and you don't need to use these 2 right now, then go to the 3-part scaling techniques, and these will offer all the flexibility that you need. Plenty of contracts or plenty of units that you can scale in and out of trades, whether you're trading futures and contracts or whether you're trading stocks and shares, ETFs and shares. Each of these can be used in a variety of ways. And again, the goal is always find a target where you think your price can get to that target. Because if your price can get to that target, you can scale. And if you can scale, you can get to break even, and from there, you have mental clarity toward your next targets. Even if it doesn't get reached, if it comes against you and gets stopped out, it's okay. You lost no money, and you engaged the market like a professional, mitigating risk first, looking to book consistent profits, and then offering yourself a position of strength to trade from. That's all you can ask yourself in trading. It's all about execution. We're going to find so many different ways to enter a market, but exit methodology can always pretty much stay the same. Every single one of us in here can find a different trade setup that we like, something that, we can really depend on. And there can be 50 different ones in here because we have several different folks in here, right? Well, trade management is one of those things where it can still be very personal, but at the same time, it can be very, very universal among all of us, the way we use these things. And there's no doubt in my mind, that if you glean nothing from the entire executive training series, these entire 10 parts, this is one part right here, that if all you did was just systematically, with discipline, implement these trade management techniques, you're going to become a better trader. You are going to become a better trader because you are inherently executing trade management approaches that build confidence, that book profits, that keep you risk averse, all the various things that you need to do and be as a trader, these do it for you. All you got to do is execute at the right spots. So I'm very excited about completing the 10-part executive training series. This completes part 10 of the 10-part series. And so this was the trade management techniques. I hope you enjoyed the 10-part executive training series. It's my goal to continue to provide fantastic training opportunities for you in the PivotBoss Premium Trading Room. And I look forward to executing these techniques with you soon. Good luck and trade well.